Welcome to our latest investment markets update. My name is Mathew Cassidy, Managing Director, and I'm joined by Jonathan Bayes, Chief Investment Officer. Welcome, Jono. Jono, since we last caught up around 10 days ago, we've obviously seen some interesting news flow, obviously some growing cases of coronavirus around the world, some huge escalation of numbers in the US. What's your observations about what's happening around the world at the moment, economically and for financial markets?
Yep. So from an economic standpoint, the big thing has been the wave of jobless claims in the United States. The last fortnight, we've seen 10 million people sign on for the dole effectively in the US, which is ridiculously high. The previous high in a week back in the GFC was 750,000 sign-ons. So 10 million in a fortnight's unprecedented. That's about 6.5% of the total workforce in the United States, and it's only likely to grow in the coming couple of weeks. So the real world impact is really significant. Yes. We've seen obviously the death rates in Europe sadly continue to rise. Maybe some good news in terms of a peaking in the rate in Europe over the weekend. But now we're faced with the front in the United States in the coming couple of weeks, which is going to look pretty ugly. Probably a bit of an uptick, certainly to watch in the developing world, I should say. Brazil and India are places to watch, and I guess maybe in a relative sense in Australia we've done a pretty decent job with social distancing thus far. Yeah.
What about liquidity in markets? What are we seeing out there? Access to capital, and obviously we've seen some new capital raisings in the market. Can you share your thoughts with that?
Yeah, and there's going to be more. I mean, to be honest, the cap raisings have gone pretty well thus far. Cochlear got a surprise raising way for $800 million, and the stock has traded incredibly well since then. Webjet had some great success with their raising, which we're very thankful for. Last week, it should tie them over probably for at least 12 months, maybe a little bit longer, because of the success of the raising. There's talk that Oil Search could need a cap raising shortly. Reese in the press as well, a variety of companies. NextDC, again, a company that we recently added to portfolios, raised $670 million, and the stock traded up. So, to be honest, thus far, financial markets are taking the raisings reasonably well.
Yeah, we saw, I believe it was last Tuesday night, the announcement in the UK that on the basis of the government's not bailing out the banks but providing additional capital to the banks to support the end mortgage holders, that the discussion was the suspension of bank dividends. Yep. And we saw the same commentary last week with New Zealand.
Yep.
How do you see that playing out in Australia?
Yeah, well, APRA have said for the time being that they'll leave it in the hands of the boards, but I'm sure there'll be pretty strong guidance for them not to take the mickey. I don't think the banks are going to be in a position to pay the dividends we've seen in the last couple of years. It's an obvious statement, I know, but payout ratios previously were high. I think we need to be expectant that dividends are going to get cut quite significantly. Later this month and early in May, we get 3 of the big 4 banks reporting, so we will get some guide for likely dividend cuts. It depends on which broker you look at, but I think we need to be prepared for cuts to at least half to 2/3 of what they previously were, which means that even on the share prices currently speaking, you're looking at yields in the order of 6 to 7% fully franked, which is is okay, but it's certainly not what they were, given that the share prices have fallen as far as they have.
Yeah, I know we've been exchanging 20 to 30 emails a day on what's going on in markets, what we're looking at. We've also had almost daily webinars with investment management groups around the world, certainly the US market, taking stock of what's happening in other broader Asia, and then certainly China as well. But what also we've been doing around the portfolio over this last couple of weeks? Has there been some opportunity to make some shorter term trades with the volatility?
Yeah. So we added NextDC, fortunately, at a good level, and proven to have about 30% outperformance in the space of a month. We trimmed a little bit before the cap raising, but that's worked out well. We've trimmed a little bit of some of the stocks after paying a couple of the oil stocks, etc. But really just trying to get a little bit more liquid in the portfolio, so that the opportunities when they present themselves we can take advantage of. A little bit of tweaking the fixed income side, but basically getting ourselves well prepared for opportunity.
Yeah. So Value. Are markets cheap at the moment? Yeah. Obviously, there's a lot of uncertainty as to how the economic environment will play out. Yeah. But how are we looking at valuations at the moment?
So I would say that valuations look more attractive than they've done in a long time, both across fixed income but also across equity. Valuation won't be the single driver for markets in the very near term. Liquidity is obviously a really big deal, but also too, valuations might look okay on current estimates, but there's the prospect that we might have a slower recovery, and as a result, this might not be the only downgrade. There's always that sort of saying, you don't buy the first downgrade, and I keep coming back to that. So valuations on the Aussie equity side, I think are starting to look pretty good. Remember, at the start of the year, we were at 20-year highs valuation-wise. If you take 10-year long-term earnings numbers, we're within 15% of the level we got to back in the GFC, so that does give us some support. The US market is very, very significantly above that, so perhaps less supportive valuation sense in the US. But also too, I mean, again, to your point, Matt, we've been talking to the fund managers. PIMCO have been making the point that in 5 or 6 of the fixed income markets in which they operate, valuations are back into the bottom quartile over the last decade or so. So again, valuations are generally speaking starting to look more attractive.
Pricing compared to the GFC, I mean, is the market close to, far away from where prices were at the bottom point of the GFC? Yeah,
well, I mean, I guess the question too is whether or not we compare it to the GFC. So yeah, we are long-term earnings numbers currently about 13 and a half times. I think we got to about 11 and a half times on a so-called Schiller PE back in the GFC. So we are starting to get to those levels. But the debate, I guess, or maybe it's not a debate, I don't think that the economy is in the shape that it was in the post the GFC. We didn't get a recession in Australia after the GFC. We're set to blow through, I think, 10% unemployment here in Australia in the near term. House prices, I think, are about to come under pressure again. So I think it'll be a slower repair for markets here. Yeah.
Sure. In our current view, I think particularly with observations for the US and the growing number of cases in the US.
Yeah. So like we probably said to you last time, we're waiting for the US to get ahead of the curve to feel more optimistic. And that doesn't just have to be confirmed cases and the regrettable mortality rates. It means actually getting ahead of the curve so that we don't continue to get spot fires, which will cause ongoing consumer angst and cause the economy to sort of stop-start. And to be honest, I don't really have confidence in the way they've approached it thus far as a layperson watching it, but watching it quite closely. So, we sort of said last week, hope isn't a strategy. And I think that unfortunately it's a key tenet of what's going on over there as opposed to good social distancing procedures. I mean, a lot of the states still haven't actually put shelter in place in as a regulation. So I'm a bit reticent to get overly excited by putting money back to work at this point because it doesn't feel like the US has yet sort of grasped the nettle, so to speak.
Yep. And obviously we commented last time, one of the big decisions we made was to increase our cash allocations really substantially in January, and thank goodness we did. How important it is to have some cash, ammunition and a defensive market at the current point in time, and probably no more important time, as we regularly discuss, to have your asset allocation right in periods like this. Any comment on that?
Absolutely. So at times like these, again, repeating myself, you go from return on capital to return of capital. When people are fearful, they go to cash. And so that's going on, and I personally think that will continue for some time yet. We've seen some major funds in the UK and the US in the last week freeze redemptions because they can't get valuations done, or indeed they can't actually liquidate portfolios. These happen in times of financial market stress. So I don't think we're at the end of that. Again, to your point, Matt, we're pretty liquid. I mean, the longest holdings in the recommended liquid portfolios, there's only a few holdings that have monthly liquidity, and we've even trimmed some of them back. Yeah. So the good thing is that portfolios certainly here are very, very liquid.
Yeah, great. And what do we have coming up? We're obviously in quarantine effectively in Australia with some restrictions and some exemptions. and also corporate earnings. I mean, what do we see the next few weeks playing out?
Yeah, so the big focus, I think, from a market standpoint will be twofold. Will be how do governments respond to the initial quarantining period. There's some hope that the curves in certain parts of the world, particularly here in Australia, have flattened. And what does that actually mean? I think that there's still a bit of a naivety that means that we're going to be going back to work sooner than we are. And I think there's perhaps a realisation that won't be the case. So in the UK this weekend, they'll have the chance to make a decision on whether they extend their initial 3 weeks. We'll get some comments out on schooling, I think, this week here in Australia. So they will be really key markers for market sentiments on when we return back to normal. And corporate earnings, as you say, Matty, we have, starting next week, the big banks in the United States start reporting. They are at the epicenter of this, doing a huge amount of national service in every part of the world at the moment to continue to get the economy moving along. And then later in the month, we've got the big social media companies and Apple who have been reasonably protected in the downtick. So it'll be interesting to see whether or not their earnings numbers are as safe as the market seems to think.
Yeah, great. Thanks, John. Now we've gone out to our advisor group and with respect to some clients to ask some questions, which we'll run through now. At this point about bolstering the quality of our portfolios for recovery, selling out of some assets that will lag and putting these into top quality businesses. What does that mean? What's his concept of flight to quality through this period, and why do we believe that's a great strategy?
Yeah, so I mean, back to the earlier comment, we have trimmed a few things in the portfolio, but there's some really good quality businesses that have been beaten up in the sell-off. And we'd previously taken the view that they were a bit too rich for our blood, so to speak, to buy into. Some of them still are, but with the market falling back, some really good quality companies are now offering up some increasingly attractive valuations where, as I say, 30 or 40% higher, we just couldn't bring ourselves to buy them.
Yeah, great. Also, clearly this has come from someone who may be a little bit nervous, which I think I know the answer for this. Should I switch to cash at the moment?
Yeah. I mean, no, we invest portfolios for the long term. And so it's very rare, well, you'll never hear us sort of say switch entirely to cash for the long term. Equities as a general rule, much like housing, you know, on average over the long term, deliver 7.5% per annum. And you've got to ride the ups and downs. And so, no, markets have already fallen now 25%, but they had fallen 35%, you know, at their low point. And we think valuations are starting to get more interesting. So no, I think that even if the markets were to pull back a little further before we start buying, which, as I say, is the central view here, we're likely to come out buying the market, I think, more so than selling. Yeah.
Through our lifetime, we've obviously seen some incredible investors. Warren Buffett would be one who's most probably regularly quoted, and he comments that you know, be fearful when others are greedy and greedy when others are fearful. What's your interpretation of that in the current market, and particularly with your comment on cash there?
Yeah, well, I mean, it's again, said it a million times before, humans drive the market, and you know, again, the analogy would be very similar to the rush for toilet paper we got a month ago. The same could be said for selling the market, you know, again a month ago, and arguably now there's a lot of people really looking for the ray of hope on markets and trying to ensure they don't miss the bounce up, and so that's the sort of greedy side of things. So absolutely, human emotion is driving a huge amount of the volatility in markets.
Yep. So just in closing off, talking about our overall strategy, we've cashed up in January, probably the highest allocation of cash we've ever had in our portfolios. We've even been trading a little bit through the volatility, but keeping our cash at hand. Just a bit of a touch on, you know, how do we think this will play out in the next six to 12 months? Will we still be in those large levels of cash, or are we looking to deploy those in really great quality companies that are producing some fantastic cash flows?
Yeah. I'm hopeful that we'll be more invested. Yep. I'm hopeful that the social distancing that's going on around the world does allow us to ensure health systems aren't overwhelmed, and as a result that we're allowed to, in small part, re-emerge from quarantine. As I say, in small part, I can't see large groups of gatherings taking place, which is clearly going to affect certain things, and travel is going to be limited. But the closer we get towards the development of a vaccine, the more likely markets are to start trading better.
Yep.
And so our hope is that over the next couple of months we'll be able to make opportune investments, and we will be more heavily invested by the end of the year.
Great. Thank you very much for your time, Jono. Just reaffirm to everybody the protection of our client capital is of the utmost importance to us. We're scouring the world, talking to the best investment professionals around the world with respect to that particular matter, and we look forward to keeping everybody updated and posted regarding your portfolio matters. Thank you very much.
Done.